So good afternoon, good morning, good evening, everyone, wherever you are. And thank you for joining for today's Future of Financial Information webinar. It's my great pleasure to welcome Jinfei Sheng all the way from California. So I appreciate the early wake-up call and thank you for being here. I'd also like to welcome Simona Abis from Columbia University, our discussant for today. We have an exciting topic in front of us. So do mutual funds walk the talk? I'm very curious to hear the answer to that question, not least as a mutual fund investor myself. Just a little bit of housekeeping. So Jinfei will present for about 30 minutes, and we will have a one stop for questions along the way, so that may add several minutes to the presentation time. So if you have a question during the talk, please put it in the chat, and I will get back to you during the question break. And we will also have a Q&A session at the very end for any remaining questions. So before the Q&A, Simona will discuss for about 15 minutes. So altogether, we will finish at 5 o'clock Stockholm time, but feel free to stick around for a little bit afterwards for more informal chats with Jinfei. And I think I saw one of his co-authors in the audience as well. So without further ado, please, Jinfei, the screen is yours.
Okay. Thank you, Michael. And also, thank you, Michael, for organizing this wonderful webinar, and also thank Simona for being the discussion, and also thank everyone for attending this event. And I look forward to any comments you're having. Also, the paper I'm presenting today is about where the mutual fund talks work, and a text analysis of fund risk disclosures. This is a joint work with Nan Xu, who is a PhD student at UCI. She is on the audience as well. She will join Nankai University as assistant professor this coming fall, and my colleague Lu Zheng at UC Irvine. So the motivation of this paper, as you know, Michael mentioned that many of us, right, are investors of mutual funds, and one important disclosure is fund prospectus. And as mutual fund investors, right, and in the United States, about 50% of US households invest in mutual funds in one way or another. So this is kind of a large investment that people are making, right? You have to choose, you know, which mutual fund you have to invest. And now one question that people have, and I always have, is do we have enough information or accurate information to make investment decisions, right? So I invest in a couple of mutual funds, and you know, nowadays, right, sometimes you get a mail copy of the fund prospectus, or you know, you got an electronic copy that you can download from. So there's kind of two important building blocks, you know, if think about from the asset pricing perspective in the literature, is about risk and return. Right, we know that, you know, it's trade-off, right? You know, high risk, high return. Now, when it comes to investing in mutual fund, do we have enough information about the risk, right, and about return? So in the mutual fund literature, there's a lot of research about, including me. Actually, I have another paper look at mutual fund return and performance. So the literature has been mainly focused a little bit more on the return part, and I would say less so about risk, but this is important asset allocation, right? But it's very important for asset allocation. Now I want to talk a little bit more why to do a little bit less in the risks. So, but the risk is important, right? So we have to know as an investor that how much risk and what type of risk we expose ourselves to this investment decision that we are having. So one important place you can collect this information is so-called fund prospectus. That's the required documentation for the funds to file with. In the United States, it's called SEC, while in other countries probably they have other regulatory body. So most investors cannot do, in general, most people cannot do complicated estimation of risk, fund risk based on returns. I'm not sure about you, but at least, I mean, we are kind of, I believe all of us are finance PhDs, and we do kind of careful research. But probably when it comes to investing, probably we will not do complicated estimation. We will rely on actually simple information such as the disclosure. The fund tells us, right? So that's why I think the disclosure is very important. So now the specific research question my course and I want to ask in this paper is, are the disclosure risk in fund prospectus informative of funds actual investment risk, right? So think about, if they disclose some risk, are they really exposed to this risk, right? So, and also, are they hiding some risks that they are exposed to, but they don't want to disclose their risk in the fund prospectus, etc. Right? So, this paper aims to answer this question by analyzing the risk disclosure in the summary prospectus. So I'm going to talk about a little bit detail about, summary prospectus is a little bit background. So summary prospectus is kind of a new required document, relatively new required document by SEC starting from 2009. So the prospectus of mutual fund can be very long, right? And but the summary prospectus is relatively short. And the purpose of the summary prospectus, from SEC perspective, is try to make it very easy to understand for the investors, and they are required to use plain languages, right? No jargons, right? Etc. I'm going to show you an example of what is the summary prospectus looks like later on. So a quick preview of main findings of this paper. We found that most disclosed risk can be linked to meaningful and well-known academic risk factors. They do have some risk that they disclose that is not can be linked immediately to any risk factors. My overall impression is in industry, people use the word risk more general, more broadly than we think, right? We usually think that if you say something is risk factor, we need to establish either empirically or from the theoretical perspective. But I would say in industry, at least from the reading these fund prospectus, they have way broader way to talk to use the word risk. Basically, anything they can think potentially can affect something, they can call it risk. But still, I think that most of the important ones are actually very close to what we are talking about in the finance literature. We developed a fund level measure to assess the informedness of fund risk disclosures. We call one measure we call risk coverage. We using how much fraction of the fund return can be explained by the risk factors that they disclosed. That's kind of the idea I'm gonna talk about the more details, how we construct this measure, etc. We do find actually a lot of funds they over-disclose, and almost half of the disclosed risk are not significant. So while in general we find that the risk disclosure is quite informative, I would say, but at the same time, funds they over-disclose a lot of risks that they are not actually exposed to. We also found that the risk coverage also had a lot of heterogeneity, and which is correlated with fund characteristics. We're going to talk about whether skew fund, non-skew fund, etc. We also found that this risk coverage is also related to future performance and risk taking, but not related to new money flows. I'm going to talk about that part. I would say surprising, but also not surprising if you think about for a little bit more. We have some evidence that a fund disclose their risk in timely manner we do look at a change of their risk disclosure and look at before after, and we found that indeed they actually disclose relatively timely, and that timely disclosure actually affected the informedness of their disclosure. Little bit of literature and contribution. I will be just really quick. So there's kind of relatively new literature that look at fund disclosure and quality of fund disclosure, etc. This is relatively young literature. I just put a little bit of paper there, and there's definitely more paper. And our discussion, Simona has excellent paper, more actually, two. I mean, at least I read two of them, the Java paper and also the rest of the paper about peer group. So it's relatively young, I would say young literature that definitely deserve more attention than it should be. So so if people are interested in working in this area, definitely is, I believe is a promising area. More broadly, I would say this literature, this paper also linked to the literature on textual analysis. So this textual analysis literature starting from mainly, I would say, from accounting originally, and focus on corporate disclosure and a news article, and then a small literature on fund disclosure. So in this paper, I would say the contribution of this paper is that we provide a kind of analyze the disclosure of mutual funds, which is important but relatively understudied. And we also focus on the economic meaning of text content in detail and try to bridge the gap between the text content and quantitative variables that we usually use in the mutual fund literature. We also contribute this to the fund performance prediction. That is a huge literature I would say one of the largest literature in mutual fund. In that sense, I mean, there's a lot of paper already. The contribution of this paper is we focus on information based, right, from the text, and create some variable from the text and try to link this to future performance, etc. Now, I will just jump into the details of here's the outline of the rest of the presentation. I'm going to give you a little bit of background about the data and what is fund prospectus, and then I'm going to establish some standard fact that we found in the fund prospectus, and then we're going to link some of these, essentially we're going to examine how informative of these fund risk disclosure by looking at a couple of measures that we create, and then we look at how this linked to the fund characteristics and fund flow performance. And later on, I would say one important question that many people care, and also including SEC, is that whether you disclose your risk timely. Now, hopefully I will have enough time to finish all of them, but if not, I already previewed the result in the previous slides. Little bit of background. So so I want to, as I discussed before, so the fund prospectus and summary prospectus is kind of not the same thing. Okay, so the mutual funds always need to provide prospectus and back to older days. Okay? And Simona has a wonderful paper look at the whole document of the mutual fund prospectus. Now, from 2009, SEC required that all the funds need to provide a summary prospectus. Now, if you read the prospectus nowadays, and there we are starting from the summary prospectus. Okay, there usually is, I would say 3 or 5 pages. Based on my experience, but the prospectus itself can be very long. I actually invested in one of the mutual funds, and they mailed me a copy, a huge copy, just like a textbook, very thick, like 300 pages. There's no, I mean, I think I'm capable to read this as a finance professor, but there's no way, right, I'm going to read these 300 pages from the prospectus. But the summary prospectus only have like 3 to 5 pages. I would say it's manageable. I invested in some of the ARC funds, and they mailed me some of the summary prospectus, and I read some of them, and I find it's kind of easy to understand, also not time consuming. Now, the purpose, why they want to have this, right? The purpose of this regulation is to improve mutual fund disclosure by providing investors with key information in plain English in a clear and concise format, while enhancing the means of delivering more detailed information to investors. So they are be clear. I mean, I'm going to show you an example. So the nice thing I would say about this fund prospectus is that it's relatively short, but at the same time, it contains a lot of information, key information that will be useful and helpful for the investors for their investment decisions. So they have a kind of, essentially in the end, this was called a summary section at the front of the prospectus. Okay, when if you you get a copy of the prospectus, but if you want to read online from the SEC ENGA document, you can get a separate document. It's called 497K. That's kind of the document we are talking about. So you don't need to deal with like the whole document. They do have a separate document electronically that you can access from the SEC ENGA. Now here's an example. So there's a lot of heterogeneity about, especially about risk. So we focus on risk in this paper because we want to understand what the risk it is. Now here, one of the important sections in the summary prospectus is called risk disclosure. The title is different. Sometimes they call it principal risk of investing in the fund or principal risk and etc. So there's a lot of heterogeneity about what they're going to disclose. This one is an example that they have been very brief. A very short, concise way to summarize what type of risk they are exposed to. So this fund is called American Growth Fund Series 1. So they have, you can see, right, it says that the primary risk of investing in the fund are, they talk about stock market risk, industry, security risk, management risk, liquidity risk, and small cap, middle cap, etc. And for each risk, right, they have very short, even not a complete sentence to describe what the risk it is. But there are some funds, they also have very long disclosure, as you can see here. I mean, I'm sorry that if you cannot read, but I cannot read either, right? So it's very a lot of disclosure about what the risk they are exposed to and have detailed explanation about each risk. And I can read the first one is called stock market risk, and then have a long paragraph explaining why all funds have exposure to this to stock market risk, etc. So anyways, the bottom line of these two examples is that they do have this section talk about risk, and there are a lot of heterogeneity across different funds. Now, the heterogeneity is great, right? So because we want to have this heterogeneity when it comes to analyze. Now, the data is quite standard, I would say, except the fund prospectus. All the other data, fund data and return data, is quite common data sources. Now, for the fund summary prospectus, we get the data from SEC ENGA, and we write a code that we can download that all the fund summary prospectus, and it's open to public, so anyone can download these files if you want. And originally is in Textual file, and we need to clear it and then do the analysis. Now we start from kind of about 3,000 funds, and then we focus on the domestic equity funds, okay? And we do not deal with bond fund, we do not deal with index fund, etc. So we end up actually a very good size, which is about 1,600 funds in the final sample after all the cleaning, and if make sure that and after merging with these crisp Thomson Reuters mutual fund holding data. Okay? So once everything is clear. Now you may be curious that what I give you two examples, right? And it kind of I give you kind of a sense about what type of risk they disclose. But how about all the funds, right? All of these fund disclosures, and what do we see from their disclosures? So a little bit. So the academic literature, right? So we have been, for people who are familiar with or heard about empirical surprising literature, we have so-called fact zoom, right? By John Cochran used as terminology. So we have a large amount of so-called risk factors. Now I'm curious, from the industry perspective, right? When they talk about risks, do they also have like a huge pool of risk factor as well, just as we are having in the academic literature? And which factors appear, appear in the fund disclosure to investors? And we were going to provide a comprehensive analysis here. Now, we do look at all of them. Now I want to just give you, we extract all the risks and risk rate first, right? And then we rank the risk based on the number of times they mentioned across the funds. Now here's a top 20 risk, in case you are curious. This is a word cloud, and that we kind of extract the information here. And I would say some of the risk you will see that is kind of makes sense to us, and we see that frequently, right? I think we see the small cap, middle cap, that's kind of size, right? Risk factors. We see derivatives market, right? That's a campaign factors, and we see equity. It's also kind of market factors. They do kind of use the word equity sometimes a lot, and also have other risk factors such as liquidity, and for people who do international finance, we see currency and foreign investors as well. But we do also see there's kind of risks that they discuss in the fund prospectus, but they are less common in the academic literature, right? So, for example, they talk about so-called what is I would say credit default. I do see one. There's small cap, portfolio turnover, bond. Okay. Yeah, active investment risk, right? So active investment risk is not something that we usually see in the asset planning literature, right? But it has been taught a lot, actually. This is kind of one of the big, but it is a common kind of thing in the mutual fund literature. There's a kind of bunch of paper look at, active versus passive, etc., and active investing as well. But I would say less common in the asset planning literature, right? We use this again. This is top 20. If we end up actually have like about 70. We start from about over 100. We got in total we got like over 100, between 100 to 200 risks that we got, and then we kind of some of the risks are similar. We combine the ones that are similar. They use kind of similar terminology. And then we also focus relatively the risks that are more important. We end up about 50 risks, but this one is top 20. So if we go down to the list that is less frequent, we will see more of these these risks that are not really commonly discussed in the finance literature, but used in the industry. Now here's a heat map about the relatively, again, these top 20 relative frequency and the time trend. So the x-axis is the time trend. The y-axis is for each risk the weight. So the dark, the color, it has a relatively high weight. I would say in general it's quite stable, right? If you look at some of these risks that are very common, are relatively important, such as active investment risk, has been always very important across different years, and there's some risks that are disclosed by more funds in recent years, such as foreign investment, liquidity. This is definitely also probably reflects the fact that we are living in a world that that everything is connected with each other, different countries, etc. Right, such as a result, foreign investment become more and more important for the mutual funds, and also there's increase in the number of risks being disclosed as well. In general, you couldn't see here, but I think you can see that the number of these risks that have relatively dark also increase over time a little bit. Now, understanding these like 20 or 50 is not easy. So what we do is we classify these, try to understand, right? These factors. We try to classify them into like 3 broad characteristic risks. Just for understanding, we don't really do any analysis with these characteristics. We will say, in general, the first group would be like portfolio-specific risks, such as active investment risk, portfolio turnover risk, and non-diversification risk, something like that. Then there's some very common, so-called systematic risk. Think about it like risk factors, right? And market risk, interest rate risk, liquidity risk, etc. And there's also so-called, I would say, asset class risks. And the largest category, I would say, they will talk about the foreign investment risk, small cap, value investing, and derivative risk. Now, I want to mention, right, these funds are classified in general as domestic equity fund. They also say that they have exposure to fund risk, etc. So they are mainly, I think, their main holding is U.S. stocks. Okay? But still, they have also a little bit other exposures as well. But we in general do not include the let's say international funds, etc. But still, right, they have risk exposures to these risks. Now here a little bit, we also talk about once we have this, right, and one important, you probably may curious about, okay, we've got a list of risk that we extract from the fund prospectus. And we've got another risk we know that from finance literature, right? So the question is, how do they match with each other? Or how do they match with each other? So what we do is that we use kind of, use the list of, some so-called common risks, not necessarily factors, and also common data that we use to kind of measure these, and choose the so-called text-based risk that we extract from the fund prospectus. Now, I want to just give you an example. For example, active investment risk, and we use a measure so-called active share. And bond risk, we're gonna use a bond index, and we run regression. We're gonna beta of bond index. That's kind of the we so-called subjective match. Now, we also want to look at, one thing is, do they actually really kind of consistent with what they are disclosing, right, about the betas? And we found indeed, we look at, different type of risks, right, different type of all these potentially important risk factors. For example, for active investment risk, we got all the betas, and we found that the top 3 betas that from test, we found that turnover and profitability beta and beta of loan outstanding from the Fed, etc., are standing out. Okay, and which makes sense. For example, for the first one, right, the turnover, which is related to the active investment risk. For example, if one of the fund is more active, right, they have to turn over more in their portfolios, called gross investing risk. And we also look at all these, that measures, the fund level measure, and other fund level beta, etc. And we found that, the top 3 beta rate is value beta and beta of bond index and turnover. Now, if you look at the first one, which makes sense as well, right? Gross investing is in the upside of the value investing, right? So the value beta actually is important. I want to point out that significant means that the absolute value, okay? In this case, the beta is negative, okay? But the beta the size is large. And etc., right? If you look at the small cap risk, and also is highly correlated with the size beta. Okay, so again, the bottom line is that here this is we just want to kind of understand, right, these risks and try to kind of create a kind of a map between the risks that we extract from the fund prospectus and the risk that we know in the finance literature, and we found that makes sense most of the time. That can be most of the risks that we find from the fund prospectus that can be correlated with the common risk that we know in the finance literature. Now, one of the important questions in this literature,
there are actually a couple of questions in the chat, but since you should wrap up within like 10 minutes, maybe we should save them for the end.
Yeah, let's do that actually. Let me actually, sorry, I mean, there's a lot of actually, because I mean, it's a paper that deal with the data, so I want to be clear about what I was talking about. So, but now let me actually talk a little bit about the results. So one of the questions we want to understand is how informative are the fund risk disclosures? Okay, we create 3 measures and motivated by the guidelines of SEC. So we created kind of 3 measures that to assess the quality of risk disclosures in fund summary prospectus. One measure is so-called risk coverage ratio, and another one is called risk coverage for the top 3. I'm going to talk about that later on. And then another one is the so-called conciseness, which is whether they over-disclose or not. Now, let me talk about the first one. The measure one is so-called the risk coverage ratio. So the purpose of this measure is try to whether disclosure reflects fund actual risk. So there's people, people talk about the funds may have incentive to hide, right? They're risk taking, for various reasons. This is particularly true, I would say, for more active funds, especially for like think about hedge funds. Of course, we do not cover hedge funds, but in hedge fund, which is a very extreme cases, right? They do not want to tell you what they are doing, right? So in this mutual fund domain, there are definitely some funds, if they have some unique advantage, they do not want to tell you. So they do have incentive to hide something. And our method is that, the method we use is more, I would say, pricing oriented. We use, we look at how much fraction of the return of mutual funds can be explained by the factor returns that disclosed in the funds, right? So if indeed, right, the idea is that if a fund discloses its risk properly, then its future returns should be largely explained by the related risk factors. That's kind of the idea. Now, the specific regression we are running is as following. We have the fund return as a dependent variable, and then we have all these risk factors they disclosed in their document, right, fund prospectus. And now the key thing we care about here is R squared from this regression. This is the first step, okay? Now, we also want to look at this benchmark, right? So we want to know, let's say, we got R squared 60%, right? But what's more important is that, there's potentially, although we kind of feel comfortable nowadays that we've got a lot of risk factors, but it's hard to argue that we know everything about risk, right? And so it's kind of the benchmark is that we know 100% of what explain these, stock returns or fund returns. So the benchmark would be compared to all the risk factors we know, right? How much of their disclosure is informative, right? That's kind of the idea. So the second step is we calculate another R squared, but now this time, the list of risk factor in the right-hand side is all the risk factors that are disclosed in the mutual fund literature. I mean, in their fund prospectus. Okay. Now, so this is we think is a benchmark about overall, right? I mean, we are making progress as kind of a profession. And as human being, right? I mean, towards understanding what's going on in the separate literature. Now, this set of risk factors is relatively complete, I would say, based on our understanding about the separate. Now, the risk coverage ratio is a ratio between what the fund risk disclosed, right, and what we know overall about the fund about the finance. So this we think is kind of reflecting how informative, right? So essentially, it's saying that the fraction of risk that the fraction of your return explained by the risk disclosed divided by the fraction, the R squared that can be explained by all the risks, right, that we know so far. And then we use that divided by each other. This is a ratio. We believe this is kind of informative ratios. If this ratio is high, meaning that this is relatively informative. Now we estimate the return of the disclosed risk. We have used a construct, a proxy for return risk returns by funds actual returns, and we use the return of disclosed and return of disclosing funds minus return of non-disclosing funds. And the portfolio return is equal with the average return of individual funds in the portfolio. Now here's some, I'm gonna skip the summary stats, I would say. I will only say one thing. So overall, if you look at the first one, the ratio itself, it's quite high, about 79%. percent of the variation in mutual fund return on average can be explained by the returns of their risk disclosed in their fund prospectus summaries. Okay? And the relative ratio, risk coverage ratio is about 80%. Okay? So that's overall is pretty good. We do have a so-called over disclosure measure. I don't have time to actually to run over here, but so we look at how many of the risk factors actually is not significant when we run the regression. We found that about 50% actually, they are not significant. So they're over disclosing as well. So they do disclose something they are actually not exposed to. Anyway, that's I think I found is very interesting. I just want to share with you. Now, another thing is like, the same thing, but focus on the top risks, because SCC saying that, you should order the risk in terms of importance. And we kind of look at the top, risks and top 3, and we found that, okay, top 3 risks still actually is quite significant in terms of explaining the ratios, the returns, about 67%. Over disclosure, as I briefly say, essentially we talk about the number of risks that are not significant, right? And I mentioned is about 50%. We also look at the number of risks in case you are curious, about 7. On average, they disclose about 7 risk factors, and they do not change much, I would say, from time to time. The changing number of risk is almost about 0. Now, how much time do I have, Michael?
About 3 minutes.
2 minutes. Okay, I probably have to be selective. Let me look at one of the, I think you're probably curious about one thing is about the performance and the flow. Okay. Now we do look at, how this correlate and not. I want to say one thing. We found that in general, the fund, the volatility that, let me look at it. Yeah, let me look at the performance. And that I found is very interesting. We found actually, if the funds are the funds that do not have skew, they are more likely to be disclosed more in terms of both the number of risks and also the about the ratios. That's I found is interesting. And also the fund flow we found is interesting is that these risk disclosure do not affect fund flows. Okay? So now what we can think about is, I don't know, essentially, I believe many people do read fund prospectus summary, including me. And now whether this fraction is big enough or not, I'm not sure. So I would say in general, people do pay attention, especially, professional investors. They do pay attention, invest with decent knowledge, pay attention to these fund prospectus measures. But that do not really affect the flow, in the sense that people probably are not that sophisticated to distinguish which fund disclosure is informative, right? Which one is not informative, right? Think about this way: we have to run the regression based on fund return and their disclosure to understand whether which one is more informative compared to another one, right? So people probably do not get that part, which is understandable, right? Including me, right? I believe, right? Do we like run regression when we invest in mutual funds before we do that? Probably not, right? I mean, it's not like we cannot do that, but probably we won't do that sophisticated thing. Now, the last thing I want to talk, probably I have 1 minute left, is that where they disclose these risks in a timely manner. So what we do is we look at, the changes in risk disclosures, right? So we look at, for example, if one fund have, 3 risks in period T, and it become 5 risks, right, in period T plus 1, right? I mean, or in other way, it's T minus 1, or in period T, they change, what they disclose. So what we do is we construct a measure that, again, the risk coverage ratio, but we compare the difference before and after the change. This is a difference of risk coverage ratio. And we look at, the change of number of risk. we found in general, indeed, right, if you increase number of risks, right, you change, right, increase the number of risks disclosed in the fund prospectus, then this disclosure become more informative, right, in explaining the returns of mutual funds. And we found this is indeed the case. And we do more sophisticated analysis about potentially other things, and I probably will skip here. Anyway, let me conclude. So in this paper, we document a close link between fund disclosed risks and risk factors in the academic literature. And we found that disclosed risk explain large percentage of variation in future fund returns. I'm not sure whether this is surprising to you, or it's also confirmed your prior. But we do also find that funds also over-disclose by about 50%. Now, my guess is we didn't really, the paper is already wrong. We do not really investigate. My guess is they do want to avoid litigation risks, right? For example, if they do not disclose something and they will get in trouble. Now, if they disclose something they're not even exposed to, they'll probably be fine. And we do find that risk coverage is related to future fund performance, risk taking, but not related to new money flows. So investors are not really kind of absorbing this information that well. And we believe this has important implication, policy implication and legal implication. And one thing I do want to point out is that probably is important kind of to have a kind of invest to have financial literacy to understand what type of risk was the implication, and in that sense, then once they have this, we read this disclosures, probably will have better understanding about what's going on, right? And in this sector. Thank you very much. I look forward to the discussion and any questions from the audience.
All right. Thank you very much, Jinfei, and indeed, let's promptly move on to Simona Abis for the discussion. Please, the screen is yours.
Thanks a lot. Can you see my screen? Yes.
Yes, we do.
Great. So, well, thanks a lot for asking me to discuss this paper. It's definitely right up my alley. As Jinfei mentioned, I also do a bunch of work on mutual fund disclosures and prospectuses. So I was very excited. Actually, I meant to be reading this paper a while ago. So it was great that you incentivized me to pay greater attention to it, to this discussion. So what's the objective of the paper stated by the authors? Well, fund disclosures, do the risk disclosures in these prospectuses accurately reflect the investment risk of the funds? And the paper aims to answer that question by analyzing summary prospectuses. My take on the contribution is that, well, the mutual fund literature, as we all know, is extremely rich, but a lot of it is based on analyzing what I call hard information, so classical information like returns, holdings, and things that we know matter. But soft information is also related to funds, and we have this soft information in disclosures. Investors are potentially paying attention to it, and even if they're not, there is potentially additional information in there, and which is why it's important to actually analyze these disclosures and figure out if we can understand a little bit better what funds are doing or how they're communicating to investors. Most papers in this space, including my papers, they focus on the strategy section of these prospectuses. I have actually 3 papers on this. The third one is very new, so that's probably why Jinfei didn't know about it, but it's actually the most related to this one. But they all focus on the strategy section. And so in this paper, Jinfei and co-authors, they actually look at the risk section, where funds describe what are the main risks that they face during their operations. And so it provides a first mapping of these disclosed risks, which is important to understand a little bit better what funds are doing and what they are communicating about what they're doing. Now, I'm biased, obviously. I also do work on this, so I definitely think it's relevant. But the main reasons why I think this is relevant is that the SEC really prompts investors to read prospectuses carefully when they're making their capital allocation decisions. and not to just look at past performance. Now, we know that this statement, don't just look at past performance. There is a lot of academic evidence in saying that that's good advice. We don't really know if it's good advice to tell investors to look at prospectuses, because not enough work has been done in showing that indeed there is information in there above and beyond what we could just learn from past performance, holdings, and other things of that type. So, what do the authors do in this paper? Well, the data is fairly standard, with the addition of the summary prospectuses that get matched to the CRIS survivorship bias-free database and Thomson Reuters holdings about mutual funds. So the first two kind of data sets are the standard ones, and the third one is this merge of this textual information from summary prospectuses. The time frame of the analysis is rather recent, so only 2009 to 2016. That's when the summary prospectuses were made mandatory, 2009. The full form prospectuses, which is what I instead use in my research, is available as of 2000. And so we have the first 10 years of information that's not really included in this study, even if it's a long form information. What's the methodology? Essentially, they take these texts, they search for sentences that contain the words risk or risks, and then they manually categorize those short excerpts around these words risk or risks into 70 unique risk disclosures. Well, types of risks that get disclosed. This is done manually. And then they construct disclosed factor returns by looking at the returns of funds that are or are not exposed to a certain disclosed risk. And they map these disclosed factors to the academic literature, both manually and through some regression analysis by looking at what common factors are mostly explanatory of these disclosed factors returns. Now, the key measure that they construct in their paper is this risk coverage ratio. The risk coverage ratio is basically the percentage of the variation in a fund's return that's explained by the disclosed risks relative to the percentage that's explained by all risks that funds disclose in a certain period, whether the fund discloses them or not. And so this ratio basically says how much of the relevant risks the fund is actually disclosing in a given point in time. That's the aim of the measure. And then they relate this measure to a bunch of things at the fund level. So characteristics, performance, actions like timely disclosure or over-disclosure. What are the key findings? They find that a staggering 80% of variation in returns is explained by the disclosed risk factors. And they find that the ordering of this disclosure is relevant and matters. The first three factors actually account for about 67% of that explanatory power. Now, they also show that funds disclose 50% more risks than those which explain returns. So it looks like there is some level of over-disclosure, potentially related to legal issues. I rather disclose more than less. So if I get sued, I can say, well, I told you so. And then there is a significant variation in the number of disclosed factors. So it's not as standardized as in every single fund discloses the same number of things in every point in time. Now, the main findings is that this risk coverage ratio tends to be higher for younger, larger, riskier funds that charge lower fees, and also funds that perform worse. Funds that disclose more unique risks, they also characterize which types of funds do that. They belong to smaller families, charge higher fees, and so on. Also, they find that funds with higher risk coverage ratio, more over disclosure, or that disclose more risks in terms of quantity, tend to perform worse in the future. They do not find that investors paying attention to it, and there is some evidence of timely disclosure. So this is how I would summarize the key findings. I know Jinfei did a great job at this, but just to put them all together in one place. Now, coming to my comments, my first comment just maybe is just a personal preference, as I also do work in this, but definitely because there is so little work done on this material, I would have been interested in seeing a bit more on how this text is handled, how it's pre-processed, what are some useful statistics about the text, like dispersion in length or complexity. It's not clear that investors would be reading the summary prospectus rather than the long form one. I know that is an excruciating work to get all the long form prospectuses, but definitely, you know, some level of comparison, even for just a sample, it would be useful to have. For instance, you know, I know that I've collected both, and I do see very similar things in the risk disclosure in both summary prospectuses and full prospectuses. It's just the full prospectuses contain more sections. And in terms of the complexity, actually is extremely complex. Also, the summary prospectus is just that there are more sections, but very often it's just a copy paste from the long form for the sections that are required to be present in the summary prospectus. So it's not obvious that the shorter time frame for the analysis is key here, because it's not obvious that there is a big difference from summary to full form prospectus, particularly as they do not find that investors react to it. So the benefit of having this shorter time frame but summary prospectus is not immediately obvious. Now, my suggestions on this would be to definitely provide more details on pre-processing. A data appendix would be great. Provide more statistics on the data, such as length and complexity, and then just try to make it comparable to the full prospectus section, at least for a sample of funds. Providing statistics would already be helpful. I know, for instance, that I have statistics for the full prospectus. I would have been interested in comparing how this fares relative to what I work with. The second comment has to do with the analysis of prospectuses. Now, a lot of my comments have to do with the prospectuses and how they're handled and how the measures are constructed, because that's really the bigger innovation in this work. I mean, the outcome variables that we're looking at are very similar to outcome variables that have been looked at before. It's just that we're relating it to these soft disclosures. And so that's where a lot of my comments are focused on. So, in analyzing these prospectuses, what the paper does currently is that they extract risks in a very simple way, which is not usually, you know, it's not necessarily a bad thing to do simple things first. That's also what I did in all the papers that I have working on this topic. But what happens is that now they're searching for sentences that have the word risk or risks, and then they manually map all these sentences into 70 disclosed risks. Now, the procedure is not easily replicable, and because it requires a lot of this like manual work and discretion in grouping these things. And also it does not account for a lot of things like the weighting. How much time the investor spends speaking about one risk versus the other is potentially important, so on and so forth. And so I think this is a great kind of place to start in constructing these risk exposures. But I definitely would encourage Jinfei and co-authors to do a bit more on this. So first of all, providing more details, again, in that data appendix on how the current methodology works, potentially with some examples, could alleviate concerns that there can be some systematic biases introduced by the methodology itself. But then I would think that a more systematic methodology could also be used. So there is a lot of work that's been done these days on topic modeling. A simple LDA type model would be able to extract these risks in a more systematic way and also provide a weighting scheme for, you know, what risks are more relevant in each of the disclosures. And so it could be more easily replicable and also more informative. So I think, you know, great place to start, but I would love to see more on the way in which this key variable is constructed. Now, with respect to the analysis, I have one main comment and then a bunch of more like side comments. My main comment is something that I've also struggled a lot with, because the first thing that we would like to do is say, are these prospectuses informative or predictive of future behavior? And I've had to scale back on that myself, because it's very difficult to relate an extremely sticky variable, which is the prospectuses, to outcome variables 1 quarter, 1 month, 1 year ahead, which are often also extremely sticky. So it's very difficult to run predictive regressions on this data and to actually interpret them as such. So something that I have done is that we have shifted the focus from predictive type regressions to thinking about prospectuses as representing a type of fund rather than thinking about the predictive nature, also because everything is endogenous, and so we can really think only about correlations between the fund type and their disclosure, taking prospectuses as a signal of this fund type. So I struggled a bit with the interpretation of all the predictive regressions, but it's nothing specifically to do with Jinfei and co-authors. I think we also wanted to start there. We did that, but then we realized that the interpretation of that type of analysis is not very obvious given the stickiness of prospectuses. Now, I'm going to spend just a minute on a couple additional comments. So in some of the regressions, there are a lot of right-hand side variables, particularly when all of the factors are placed on the right-hand side. And that seems to be a bit too many right-hand side variables relative to sample size. So I would suggest using some shrinkage method, maybe lasso regressions or something like that could give more powerful estimates there. When measuring overdisclosure, something that they do is that, again, they put all the factors on the right-hand side that are disclosed, and they count the percentage of them that are predictive of variation in returns. The issue is that a lot of these factors are going to be correlated with each other. So some of them might show up as non-predictive, whereas they actually might be predictive if I had looked at them in a univariate sense. And so just counting the predictive factors in a multivariate type regression might lead to overestimate overdisclosure. And so I would suggest like looking at robustness in a univariate setting. Now, there's a huge explanatory power, and whenever that happens, on one side, we're all extremely happy because it looks like there is a lot of information in there, but also we need to do a bit more work in convincing the audience that there's not anything mechanical that's leading to that. And so something that, for instance, I have done in my papers is that I've constructed some placebo type categorizations and just verified that results do not go through when I construct the key measure in a kind of semi-random way. And so I would suggest that they do that just to reassure the audience, that like the readers, that there's nothing mechanical going on. And the final comment is more about the pitch or positioning. The current paper is motivated saying that investors take all the information from prospectuses, but then they do not show any reaction of investors to the information contained in them. And so I would either change the pitch a bit, or I would do more work on showing the connection between investors and prospectuses. I know that, for instance, in my latest paper on this is actually the focus is learning from prospectuses, and we do show that the investors do react to prospectuses. We use a summary section in the strategy section in the full prospectus. But here I would say either changing the pitch a bit or doing more to establish that connection. Now, to conclude, I think this is a very interesting paper and a very interesting topic, admittedly biased on that last one, but I'm looking forward to seeing more details and more analysis on the prospectuses content, particularly on these risk disclosures that have been even more understudied than the rest of this information. Okay, that's it on my side. Thanks a lot.
Thank you very much, Simona. So I know you need to run to the next seminar. That's the busy virtual reality we all live in. So
yes,
afraid we'll have to skip the response from Jinfei, but I'm sure you can stay in touch and exchange.
Definitely, I'd love to.
Yeah.
Insights.
Thank you very much, Simona. I will write an email about some of I do have some quick response about some of the comments. So one thing I think regarding the LDA, so I mean, Simona is gone, but I'm going to email her about so I just quickly respond probably to the audience. I think first I thank Simona for the excellent comments. I think all the points are well taken. We do have actually more details in the papers, so we want to keep it brief. And so we are kind of having a kind of so-called online appendix in progress. We are deciding how many details we want to add. In the appendix. We will definitely add that. We do have a lot of details that we can add it to the paper. Now, regarding, I would say two comments to replies to his two comments. One thing is about the predictive and the correlation one, which I think is well taken. This is a literature in mutual fund, so we are not saying that this one going to predict. Or this is like next period. We actually, in the paper, we do be careful about the wording. We are saying that it's more about correlation, but even that regression is predictive, but it's a correlation, we agree. So that part, I would say probably we can do a little bit more in the paper to be clear We do mention that, but we should be more clear in the paper that we are mainly focused on the correlation. We are not establishing any, causality, whatever. That is more about correlation. Second, regarding the LDA, I'm a big fan of LDA. I do have 2 papers that use LDA. One look at the online reviews, another one look at the ICU prospectus. Now we do start actually for this project at the beginning, we do start from LDA, but I do also have paper use a simple method that use, find the keywords. And now my take is based on my understanding of this literature is that depends on what you are looking for. If we do have a good prior about what we are looking for, in this case, we know that we are looking for risks. So in this case, the simple keywords method, dictionary-based method, is actually more better based on my experience. So now if we do not have a strong prior, we don't know what we are looking for. We want to get something from the text, right? First, then in that case, LDA is better, and we were gonna use LDA to detect potential topics, latent topics first. Then we're gonna learn from that. So in this case, I think the simple word dictionary-based method is still better. In this case, we do try LDA. We do not find these topics are informative, right? So we do find that is not informative. So anyway, so that's kind of the idea. So I believe so. Indeed, right? So if we can use a little bit relatively new method. And I also use like word embedding in one of another paper. So technical wise is not the issue at all. But I would say from the motivate for the research question is based on, I believe this dictionary-based method is better in this setting because we are look at is explicitly about what the risks we are looking for. So yeah, that's the case. Anyway, yeah. So I'm now open to the floor to any questions that I do see people are raising hand.
Yeah. So first, thanks, Jinfei, for these additional insights, and we will move on to the Q&A shortly. But for those of you who need to take off on the 1 hour mark, just wanted to mention that after Easter on April 7th, we will be back with our next event, also about disclosure, and also a speaker from California, incidentally. So Zheng from USC will present life cycles of firm disclosures, and Jessica Jeffers from Chicago will discuss. Thank you for joining today. If you need to leave now, and otherwise stick around for the Q&A.